Good afternoon, Scott Redler, T3 Live, here with today's recap with a special guest, Stephen Grasso, from the floor, guy that I've known for a long time.
Pleasure to be with you.
I think I met Steve 4 or 5 years ago in the beginning stages of Fast Money.
Long time ago.
Long time ago, we're on the floor. You know, you see him all the time on Fast Money. He's always coming up with great levels to trade against, very tactical approach as well. He deals with a lot of institutions. So I think what we want to get here is somewhat of a look from him, because we talk a lot about active trading and tactical, and it seems like traders do it and everyone from home wants to do it. But you know, there's I think a little bit of a fallacy where people don't think that institutions like to trade 1 to 3 days and that they take profits. What would you think is like the typical time frame?
Well, you know, you don't have any idea of seeing how long they're holding these positions for. But I would say that they're a lot shorter than they used to be. And they can't keep catching this falling knife. Every time the S&P falls off a cliff, it's not as if they're going to continue to buy without making sales. So I have seen them turn over their positions a lot more frequently than they once had. 10 years ago was the holding period were multiple years.
Right.
Now they could be multiple months.
So it just keeps getting a little bit shorter.
A little bit tighter, because that's the only way to make money. You see it, I see it, right? This is a trading range-bound market. So unless you're really buying these pivot points in the marketplace, you're not making any money. It's very frustrating for both the institutional investor and the retail investor.
So with that said, you know, would you say last week, going into the EU summit, did a lot of them come in flat-footed where they weren't expected for something to get done, and that move on Friday took them by surprise?
Whenever you see the market ratchet up the way we've seen in the last couple of weeks, days or weeks, let's call it days, you wind up seeing people scramble to cover their shorts. So I think it's more or less, it's not the institutions that are really chasing it right now, it's those shorts that were trying to play this market off of Goldman's most recent call, because they've been all over the map with their calls. So their most recent call was us trading down to 1285 in the S&P cash. So as soon as somebody said that, everyone piled on and got more short. When the market reversed and went higher, everyone scrambled to cover their shorts.
Right, and if you look at the chart here, you'll see exactly, I don't understand how their calls are working out. Like recently, or not as recent, they were talking about generational buy right around here, around 14, 15, and then pow. That's when we rolled over, and that was really when this head and shoulders top pattern was forming. You remember we talked about it so many times, the left shoulder, the head, the right shoulders. This was your neckline. Here was your measured move, about 100 handles. And then once we met the measured move, this is when they brought down their estimates for the S&P. We were trading below the 200-day. They're like, okay, now we want 1160 right before the buy. So I know my guys almost make fun of every time.
Well, could you imagine the benefit to guys like yourself and myself is that when you're looking at these charts and you're looking at these levels, Scott and I have the ability to be flexible and rotate in and out of positions. But Goldman Sachs, when they make a call, it takes forever to get through their pipelines.
Right, that's true.
So they have to go through a bunch of hoops and hurdles to actually make the call. So the call actually could be way late. And that's why you want to talk to traders versus the guys from the bulge brackets.
Right, because we're sitting here maneuvering a sports car and they have a Mack truck.
Right.
So in order to get through their Mack truck, it's old news typically already.
Right.
So I remember the call right around here. Actually, the Goldman call was pretty decent if you go back to the chart, because this was intermediate sell zone. I remember talking about it. You know, everyone started to get a little upset because I'm like, we just met the intermediate target. We talked about this inverted head and shoulders pattern where you had the left shoulder. Here was the head with that little reversal. Came up, showed commitment here. This was 30 handles of depth in the right shoulder. So that's what gave you this first move. So they made the call right here. This was that wide range bar that took us back to what? 1306, 1309. I heard Steve talking about this level a lot on CNBC. We talked about it. The reason why of the importance was the fib retracement. You go from the low to the high here, and that was at 61.8%, the last line of defense for the bulls.
Right. So, and then just to top off that thought, their range was 1285 to the downside, and 1390 was their stop out above if it didn't work out. So this is probably the best call I've ever heard Goldman make, because they actually gave you bookends to the call. Usually they give you one side. If you remember their most infamous, I should say, call on oil, it went totally the wrong way.
Oh, they said they said 250, and it was at 140. It went $7, and then it got crushed.
Crazy, got hammered. So now if you look at it, if you start trading these charts that you're putting up here, you have to look, the 200-day moving average is now at 1300.
Right.
So, and the 50-day average is at 1339.
Right here.
So the way I would be playing this is 1385, or let's call it 1370. That's going to squeeze out a lot of shorts if we break above there. Would you agree?
Yeah, well, that was the whole thing about the last call. It looked like there was enough pent-up momentum. that could you hold your shorts from 1360 to 1390? They were covering there, that would have taken it to 1410.
Right.
So right now everyone brought down their estimates on the S&P, so they're like, okay, they're bringing it down, but there's a risk to go to 1380, 1390. So like you said, if you go to the chart, if we hold, I'd say two levels here. First, we held an important level today. We held that 1355. We didn't even get down to the 50-day. So if we go sideways up here and hold the top 20% of this wide range bar, if you were short, I know if I was short, I'd be shaking on my boots because there's no way I would be able to handle holding a short to what could be a move to this 1385 area. And if you remember this inverted head and shoulders pattern, the real measured move, this was the interim one, was from about, 1330 down to 12, the head was down here at 1260. So that's about, 60 handles. So from here, that's a 60 handle move that takes you, what did Quinky think, up to 1390. So we hold higher here, and if we obviously hold above the 50-day, I think that lets out a little pent-up momentum because it gives people a chance that if they were rolling up their short, they could actually salvage a trade and get out of it versus being trapped in the trade.
I think the big issue, though, all these levels are perfect. The big issue is we went from focusing on the Eurozone, and now people feel as if they could breathe a sigh of relief, but now we're focusing on margins here and margins being compressed. So I think once we start rolling into earnings in the next week or so, once they start ratcheting up, and everyone's looking at Jpmorgan. We heard Jamie Dimon said that they're going to beat handily. He doesn't use those words lightly. So I think you're going to see a blowout number from him, but it might not be enough. So I think we're going to start looking at margins being compressed. It's the same old story. Now we're going to focus here. And what have we seen? ISM bad, Philly Fed bad. So slowing growth here, and it's not just in the Eurozone. It's not just in China. It's here. It's in our own backyard.
And we're seeing that with the pre-announcements. And over the weekend, everyone said growth is slowing, all the ISMs, and the market's trying to ignore it because of the tactical approach right now with that move on Friday. So they're like, okay, we're slowing, and that's why the EU on their 19th final meeting finally did something. So there's only so long that the street's going to absorb bad news until maybe those earning reports come out, and then they start pre-announcing the next quarter, which could also be tough.
100%.
And with Jpmorgan, since you're a master at the levels, I know that I'm watching Jpmorgan here, and I know that it was funny is, when they finally came out and said it was 4.2 versus 2.2, that was your reversal. Here was your commitment. And I do think there's somewhat of a floor here. Do you think if they do have a great report, I think that they can come up and fill this gap, and this would probably be the sellable area. So I think this 37.03 would be the line in the sand for shorts. Above that, you get into this gap, and then that.
The only issue is that you're looking at quote unquote banks with a yield curve that is not too conducive to higher profits. So for me, it was the same area that you're talking about. It was that 32.5 range where we bounced pretty convincingly. So I would look for that 34 level to hold, and if that 34 level doesn't hold, then you're going to see a revisit. We probably go into the high 20s. But if not, we probably...
Wait, so you're saying if we break this little...
If we break that level, I think that we're going to revisit 32, and then we're going to have because now we're going to be focused on slower growth, and no one's buying financials in a slower growth environment. This was a one-off, basically, for European worries, and obviously this huge whale of a trader, right? So this was really a stock-specific story. So you can't use this as an overlay for the whole entire market. And if we see slower growth and we see earnings miss, you're going to see Jpmorgan trade down considerably.
And lastly on that, I've been watching Goldman Sachs, and I know it bounced off 90-60, but to me, that chart looks vulnerable. I know that you cover a lot of guys there, you might not want to talk about it, but Goldman Sachs, it just held this, the support from the 90s, but it's below all the moving averages. It's been acting like death. It's below the 200-day. It's below the 100-day. I would say as far as a quickie, it might try and push through this lower area. So like tomorrow, the price point, you would probably have this as a 97.60. Maybe it pushes through and fails. So do you think it's better to sell Goldman into 100, or think that it can continue higher?
Well, I'm a firm believer in, as the market goes, so do these individual names, right? 70% of all stocks trade with the overall macro market. But when you're looking at Goldman, it was the most hated stock on a political level, and now Goldman has been replaced by Jpmorgan. So I'm still in the camp that if the market comes in, you want to be a seller of all these. I'd be selling all financials on strength. The only ones I would be buying are your BB&Ts, your Wells Fargo, your U.S. banks. I think you're safer there.
Okay, and I agree. So you buy those on weakness, you don't add on strength. And lastly, we're just going to talk high beta names as far as institutionals. I talk Apple every day. You see a lot of interest from institutions? They traded every day, every few days?
You know, it's odd with Facebook coming out. We saw what names they sold, right? I mean, we've spoken about this on Fast Money a lot, where they sold the price lines, they sold the apples to buy Facebook. They even sold Google to a certain extent, but obviously Google had earnings that sort of upset the picture, so you couldn't see
Twice.
that. Exactly. So you couldn't really see it. But you know what they're selling. To buy Facebook. So when Facebook reversed and went lower and surprised everybody, they went and they bought the same names that they sold. So exactly. So you do see that institutional clamoring for some of these names because they're the mainstays. And Apple, we don't have to discuss the environment of Apple right now, right? I mean, it's its own ecosystem, and as well as Amazon, quite frankly. Amazon created its own ecosystem right off that 190 low to 230 now.
Apple just had a nice move, 2-day move. It just cleared this 590, so let's see if it could hold above that moving forward. Looks good above all the moving averages. As far as Amazon, I agree. Had a nice earnings report. Came in a little bit, little profit takers, held a lot of this gap here, reversed, heading towards the highs. I love Amazon.
And Amazon, keep that chart up. 222 is really the level for me, and it actually broke pretty recently, and I thought it was going to be heading back down to 215. But the problem is it didn't confirm. It didn't confirm that move. And for a lot of the people that are watching this program, these moves have to be confirmed so that it validates the actual movement. And once it didn't break down that second day for confirmation at 222 level, you saw Amazon just start to ratchet higher. And it could be going to the most recent highs, and it's right above $230.
Yeah, 233 is right here. And Google also, held by a thread. It's been an underachiever. It's probably the worst high beta name right now. But if you look at it on a few different time frames, they've had 2 bad quarters. It's basically been given a pass. I know it did come down to this, 555, but here too, lower little pivot. So it does have some room back to maybe 594. So maybe they finally come out and they have a decent report. Because if you go still, I know with traders, we like immediate gratification. This is where it came public, hit its peak, pulled back. It's still trending higher. It just hasn't performed well, and rightly so with those earnings. So at this point, you still have this, high to trade against here. I say as long as it holds above 555, it could be held. But again, it's still one of the weaker ones. And lastly, Facebook. The last 2 days, it showed relative weakness to the overall market. So if you look here, basically, I think the underwriters didn't do it a favor with the way they came out. Were you surprised with the estimates, or just say the upgrade cycle that they had?
Well, I think
or no upgrade cycle that they had.
When you turn around, it was the adding to the float that really killed the stock.
Right. So that was on day one.
Exactly. So day one that killed it, and now with the analysts coming out and following it now, you know that a couple of issues are happening. There's going to be a lockup that's expiring. That was a 90-day event. So we're basically a little more than or halfway there. But also it's being added to the index. Remember, the old thing was it had to be around for 2 years.
Right.
Now they bypassed that, and that was a way that NASDAQ actually stole the listing of Facebook, because they're saying that it didn't have to be listed for 2 years to be added to the index. It could go earlier. So they're hoping that compensates for the lockup expiring, so that stock that comes to market and those lockups that are expiring are diluted by the add to the index, and these index players will have to play it and buy it.
Exactly. So hopefully they don't do a secondary on a day of strength, because that'll kill us all. But here, last 3 days, coming in a little bit on Facebook, I would say in the cards could be a retest of when it broke above this 2810, which was a nice buyable area. Here was that little red dog reversal that happened. This was your buy as it broke this mini trend line. And then obviously everyone thought that they could make free money, that all the underwriters would raise the targets through the roof, and it's sold off. So if you sold it into this area, okay, I think buy it back here. Don't be shaking out there. And I just have a question. Do you know what a red dog reversal is?
I've seen you post it so many times that I actually make it useful in anything. We talk about it around the house all the time.
Oh, you mean like if it's your turn to clean?
I say it's a red dog reversal. That's usually what happens in my house. I got 4 kids. There's always a red dog reversal going around. But God, why don't you tell the viewers what it is?
All right, the last one, a red dog reversal. It's a counter trend move. That's calculated. That's all it is. If a stock had a huge up move, it's a way to play it short. If it's had a huge down move, it's a way to buy instead of just the cost average game into the low. So with Facebook, it was a great red dog reversal here. I'm going to give you a little lesson, Stevie. It tried.
I could always learn something.
Okay, so here is the high, right? It opened up at 42. Crap. Boom, closing the lows. Follow through to the downside, follow through to the downside. Then all of a sudden, you had this little bear flag here. People thought, maybe this was enough, that here is enough selling. It broke lower, so you had to get out right here. Once it broke this area, this was the level that a lot of people spoke about. They said if you break 30.94, you could see lower prices. This was your first Red Dog reversal. What it was is it traded below the previous low of 27.86, so it stopped anybody out who's been trying to buy it this whole way down, saying, oh my goodness, now it can go to the low 20s, and then people press a short here, and then what happens is it reverses, and then you buy it at 27.86, you put your stop at the low of the day, so that's 26.83, so about $1 risk, will wind up being a good trade. But then what happened here, it didn't work. Then finally, at this lower price, the low here was quickly 25.76, traded below it down to 25.52. You could have bought through this high, or the low here at 25.76, a quarter stop. So for 25 cents, that's your defined risk. You had to move from below 26, and it never violated it all the way back to about 33. So you had a 25-cent risk. You didn't have to catch a falling knife, and you had a nice trade there. And it happens on all different types. It's really like a reversal in outside day, but I give it a funny name because
it's your name.
This is my name.
It's your
a
name.
funny
That's
name.
the way to market
I got a big head, so I like to have something named after myself. So pleasure
to be with you, man.
My pleasure
Nice
as
to
well.
be in your house.